let's just start there. How do the nonstop flow of headlines, sometimes contradictory, often contradictory, trying to figure out what the macro is really telling us?
Yeah, so I kind of base a lot of the decisions and thinking on history, right? What does history tell us looking at past oil crises? And what we are seeing is pretty much similar to what's happened in the past when you've had oil going up significantly when a geopolitical issue hits the tape. And typically, it's that first instance risk premium, and oil is always the first asset to react.
The first shock, kind of?
Exactly. If you look at the S&P, it's down only 2%, right?
Right.
Of course, emerging markets, Japan, Europe are down between 5 and 6% in the last week. But the transmission is clearly on the oil side. And I'd say that this reaction this time is higher than the median over different crises. So we are watching this closely. And for me, besides the conflict, the single most important thing is how long does the Strait of Hormuz stay closed? Because that's where 20% of global oil supplies go.
So how do you price for that? Because as you mentioned, in some ways, this is a bit unprecedented. So you look back at history to be a bit of a gauge. But how do you price for the idea of this maybe being more prolonged than anticipated? How do you shift your view, if at all?
I think I'll zoom back a little and I'll say I think a lot of the geopolitics today is about resource asymmetries between US and China. So the big difference this time is US is self-sufficient in energy and US is an energy exporter, and US has all the energy supplies with the Western Hemisphere, and China has critical minerals, right? And China is an importer of oil from the Middle East. So let's keep that in the back of our minds. And the key is, when does the shale tap open, right? Shale gets productive to produce at 65 plus. So you get supply from the US when prices go up those levels. So I think you need to keep all of this. Of course, if it's very prolonged and the strait remains closed, it flows into proxy militant groups, and the Red Sea gets into question. That's like the worst case escalation ladder. I don't think we're there yet. That's not our base case, but that's how we kind of think about price ranges within a certain base case assumption.
So when you look around the world, and we've talked about the outperformance of non-U.S. markets, and we know that some of them have taken some pretty big hits here as a result of this war, where do you find the best opportunities? And then how does that compare to what you see in terms of U.S. opportunity?
Yeah, so I think the world is really multipolar, and therefore opportunities are multipolar.
Yeah.
I mean,
but that's kind of always the case, right? Or no? Or
I think it's more pronounced because I think three things are happening. There are two spheres of influence, the West and the East, with US dominating one, China, the South Sea initiatives and blocs there, the regional trade reconfiguration, the de-Americanization of trade agreements, and that's creating new supply chains, right? That's rejigging the infrastructure, the industrial capacity, the state-led industrial policies. That has created opportunities outside the world.
We just talked about, there's a story we're going to talk about with our Mark Gurman in a moment, about 30%, I think it is, of Apple's iPhones are now made in India.
Exactly. And so there is a lot of all of that going on. And I think even from the AI perspective, right, the story has to move beyond just the model creators. The way we've scaled with compute and algorithms and capital and talent, the opportunity is really beyond the model creators to who's really using it. And the different pockets of the world, we're seeing that application of the layers both within the US and outside. So that's interesting. And as a portfolio manager, I think the key for us has been having anti-correlated alpha sources. So we have been positioned for a geopolitically charged world, for a multipolar world. What does that mean for all, energy and defense and that ecosystem? So a lot of opportunities. Emerging markets feed into the AI supply chain.
Right.
Where are the bottlenecks in transformers and chips? You have other countries that fit into the commodity supply chain, because a lot of the new physical AI, which is embodied AI, needs commodities.
Right.
I think after this incident today, energy security is going to become a very critical national objective for most governments. So what does that mean for the energy supply chain, the nuclear supply chain, and uranium, which fits into that? So there is a commodity tailwind for some commodity countries on account of some of these things that are brewing in a geopolitical space.
We just have about 30, 40 seconds here. Do you have a favorite market, though, when you look around the world?
I think I have more favorite themes than markets, because I think there are themes that span across. I do like financials outside the US because I think there are new credit cycles, they are deleveraged. I do like pockets of the geopolitical hedges, which I spoke about. I do like the AI in the application layer rather than the hyperscalers. I think models are proliferating, but it's the users of AI and how that is happening. So lots of themes that are promising at this time.